Hey, welcome to the podcast. Thanks for joining me. Appreciate it. Well, the stock market quite volatile today, and kind of a strange day when you break it down. The Dow Jones finished up 72 points, about 0.5%. Looks good. Transport's up a little stronger. Utilities were the strongest of the bunch, and of course, when they lead, sometimes there's trouble brewing. S&P 500 was flat on the day, and then as we scroll through all of the different indices, you will notice that the NASDAQ 100 down 1%. You can see that there. So kind of a tough day overall for tech and some of the big NASDAQ leaders. And you see the Russell 2000 eked out a gain. Of course, oil service stocks got hit pretty hard, and the bank stocks were up. So it was a very, really, I think, actually a good day from the standpoint of some things worked and some things didn't. Remember, if we go back to the summer of 2011, just a few months ago, everything was moving in tandem, either for the good or for the bad. Remember those days where we had 4 days in a row where the Dow was up or down more than 400 points? And on those days, either it was all red or it was all green. So that was something that we saw, just a few months ago. And now here we are in 2012, and we're seeing these days where you can still eke out gains in certain stocks and certain sectors. So that's kind of a positive. Now, we did have some economic data today. We had retail sales, which came in better than expected, and the futures got a boost. And right out of the chute, you can see the first tick here of the day. This is a 5-minute chart of the S&P was up, and then it gave it all back and then some, and then it was just gyrating back and forth and back and forth. Tomorrow, we've got housing starts coming out, so we'll get a little more clarification. There's I think one of the biggest debates going on right now is, has housing bottomed? And there's, just kind of boots on the ground stuff. You are seeing and hearing about higher prices, at least in the Texas area. You're hearing faster sales, faster, closings and things like that. So that's very encouraging. I don't know nationally. I do think that perhaps we're reaching the kind of the flattening out where it's not free falling. But to say is it's recovered and we should go buy a bunch of stuff, not sure. Those stocks have certainly performed well in the last few months because the trajectory of the decline has softened. But to say it's going to start heading the other direction, I don't know. I think the equilibrium is starting to come into play where you are seeing investors get off the sideline, and I think you're starting to see at least some equilibrium in supply and demand. And overall, obviously, that's what's going to lead to a bottom, and it takes several years to do that. And remember, though, the market peaked in some areas in 2005. So if it peaked in 2005, here we are in 2012. It's been 7 years already. But regardless, we had some of the data come out today that was a little better than expected. Empire Manufacturing came in much worse than expected. But overall, the stock market bounced up at the opening, gave it all back, gyrated back and forth. It had a pretty nice upside hour here in the really the 1 o'clock hour, and then that was because the dollar started falling very rapidly, and then we of course weakened into the close and finished basically flat on the day. Now, I mentioned the kind of some of the good news as far as the stock market being, having some places where you could hide out today, and some was good, some was bad, and that was probably net positive. Overall, we're still working this. We're still oversold, I think, and actually looking for a rally. But here's the thing. One thing that's concerning me is when we look at some of the leadership stocks are falling. Now, you could view that and say, well, hey, that's great. Finally, they're correcting, and we'll have, a garden variety correction, and, these things can't go up forever, so that's actually healthy. Others would say these are the only things keeping the market up, and it's going to fall now. But Apple, we had talked about the other day, and I think maybe the last podcast or 2 podcasts ago, about once it started to crack, what levels could we look at? And what we're looking at here is Apple was down $25, about 4%, a pretty hefty decline. It's down about 9% from the top. And if I zoom in here, you'll see that this is the 50-day moving average in the pink, and then this line I've drawn is kind of the old breakout. That's an area I'm looking for, which could be somewhere around the 560 area. So maybe another day like today. And then I think you dip your toes in Apple because, again, we're not talking about a stock that has a $150 PE, right? We're not talking about a company that's wildly expensive. We're just talking about a stock that has gone parabolic, and it's due for a correction. The question is it a correction, or is this going to be a losing trade going forward? I think it's still a buy the dip stock, and I've been waiting for it to pull back, and now we're getting our chance. So 9%, hey, it's getting close to at least take that first piece. If you're going to buy it, maybe you buy the 1/3 position. So be watching that level there around 560 or so. I think that's an area that's going to be pretty important. It's actually at a pretty important area right now because it gapped up here on the 14th of March. And so, we're right at that level right now, and it kind of bounced off that today. So let's see if it holds. If it holds there, fine. But really the downtrend it's been in, that's something that is needs to turn the other direction and break out of there. And we're going down on heavy volume. So that's something. Now, you are seeing people still come out, upgrade the stock. We heard about potentially an iPad mini coming out. So there's a lot of catalysts for the stock still. But obviously there's been a lot of selling in the last few days. And on days where the overall market is going on without it. Not the NASDAQ necessarily. It did that the other day. Today, it was primarily the Dow going on its own accord. And, of course, the Apple is not in the S&P or the Dow Jones. Excuse me, in the Dow Jones. It's in the S&P and the NASDAQ, which is why they were heavily weighted there to the downside. It's not just Apple. It is a lot of leadership stock. I mean, if you go down the list here, you can take a look at, and it could be anything from, Priceline, which is really getting beaten up here, down 4.5% also today, and it broke out, down in the 535, 550 area, and then it took off, and now you see it's down $33 today, which is 4.5%. So it's moving very, very similar to Apple. And Starbucks. Starbucks has been a great stock. And after this little breakout back in the early March time frame, it's been going straight up. And today was an outside reversal day where it went up to a new high and then finished it down and was down 3%, again on pretty heavy volume. So, some of the leadership, it's not just about Apple, but some of the leadership, the Googles, are starting to fall apart. So that's something to be concerned about, I believe. But also, if you've been wanting those stocks, you're getting your chance right now, and taking a dip in the water is the first step. I'm going to switch gears for a minute. There's been a lot said about, obviously, every person I meet talks about the debt and the stimulus that's gone into the to the stock market, and how is that sustainable, et cetera. And again, we don't know because this has never been done before. Just like housing was a big experiment back in the 90s. Like, can we get everybody in America into a house and be a homeowner, which didn't work out too well. The same thing's happening now. The Fed is running their own experiment with all this quantitative easing, and of course all the governments around the world doing all this stimulus. But here's the thing. This is for some of you, you've seen this picture before. I've shown it to you before. But for you newbies, this is the picture of the monetary base. Coins, paper currency, all the money in the banking system. It's basically money. And as it's gone up, this is about a 6.5% trajectory back to the 60s that it goes up, which has been normal. If you look on the right side of the screen, since 2008, it's gone up at just an astronomical rate, and practically almost quadrupled during that time. So that is the stimulus and the amount of money in the system. Now, you look at that and you say, how come we don't have just rampant 70s-style inflation? Some of you would argue that we do have wild inflation when you look at gasoline prices, when you look at food prices. But in the big picture, we don't have real estate prices racing up. We don't have wage growth racing up. And that's why the Fed tells us there's no inflation, because they look at all these different things like that. Why aren't we seeing rampant inflation right now today? Is it just delayed, or is it something that's coming pretty soon? Well, here's the next part of that story. This is the next page. This is the money multiplier. When the Fed prints money, it generally has this multiplying effect, and that comes from how fast money is not only put in the system, but how fast it goes from person to person to person. And we've talked about this before, but if I have money and I go out and buy an iPad, now Best Buy can hire more employees. Those employees can go and fill up their house or their apartment because now they have more money, and then of course because they have bought something, so this dollar circulates from place to place. How fast is it circulating? You can see back in the 80s, money multipliers are around 3. every time the Fed printed money, it had a $3 impact essentially. It's been declining, but in starting in '08, it's actually now 0.839. So the Fed feels like, hey, we can print all day long because the money multiplier keeps declining. So they're more concerned about deflation than inflation. And as I've showed this picture to various folks over the last couple of years, I look at this and scratch my head. Why isn't it having a bigger effect? Here's the reason why. Right now, you have a deleveraging process going on. And what that means is essentially personal balance sheets, corporate balance sheets are becoming more narrow. Not the assets are going down, but also the liabilities are going down. People have been in the last 3 or 4 years since the financial crisis in what I'll call the Dave Ramsey mode. Pay off all debt, hunker down. And so what happens is they're putting all this money out there, but people aren't really wanting to take on more debt. Now, there are people, obviously, that need to take on more debt to live on. I'm talking about the big ticket purchases. Are they going out buying the new house, the new car, all those types of things? I think that deleveraging process is offsetting all this money that they're pumping into the system. And so what happens is it's not having a typical effect. The problem is that once the deleveraging process is over, and people look to add more debt and start leveraging up a bit because rates are so low, this could go out of control and spike up. That's when the Fed would stop keeping rates low, and they say, oh, we'll just take it out of the system. It sounds easier said than done, so we'll see if they're able to do that. But that is precisely why all this stimulus, which is helping in the sense that, yes, risk assets have gone up the last few years, but is it really helping the economy? And the answer is not like it typically does back in the 80s and 90s. And it's because we're going through a deleveraging process at the same exact time. And remember, deleveraging can be somebody that had $1 million home and maybe owed $1 million on it. Those two things, they have now lost the home, so their asset has gone away, but also their liability has gone away as well. That's the deleveraging process, and it takes multiple years, and we're going through it and still going through it. So there's some people that just aren't taking on new debt anymore, and but that's why you are seeing this lack of huge inflation, which, again, I don't know the end of the story, and I don't think Uncle Ben Bernanke, knows the end of the story either. But it's something we have to keep an eye on. But this is something I'm watching, and I know the Fed's watching as well. That money multiplier still is below 1. So that's something that you may not see on CNBC. That's what's going on right now. Just to sum up, I think the overall market here, it's still gyrating. You can see, obviously, we went down 5 days in a row. Then when it bounced, had a nice day where it went back up above the 50-day moving average, and everybody said, oh, good, we're in the clear again. And then we come back on Friday and went back below it. And then today, back up to it and failed. So we're kind of, hovering around the 50-day moving average. And then, of course, now what you have is a 20-day moving average is rolling over. So from a very short-term perspective, we're still oversold, and we're not seeing a ton of damage. But you are seeing a lot of the leadership stocks, as I mentioned earlier, starting to correct. And it could just be a good, healthy correction. So I'm not looking to get too eager here on the long side, but certainly after this correction runs its course, I think there's going to be some things to buy, and it may be starting with Apple, who is now coming back into a more comfortable place. It is funny, when you think about Apple down $25, it's going to be all over the news, and yet when you take the zeros off of the end and move the decimal place over 1, you have a $60 stock that went down to 58, and yet it's making major news. But it is Apple's, their trajectory, $580. And look, a 4% move is a big move for a big large cap stock like that, and on heavier volume. But so let's see if that continues. But right now, don't make any huge moves one way or the other. That would be my advice. If I was giving you advice, which we're not, this is just an entertainment show, right? But anyways, I would say just hold pat right now. And look, some things may get stopped out here, and that's okay, because as this market has run up, there's been a lot of things that may have been extended, and if they get stopped out, we can always buy them back. If there's some really good fundamental buys and it's getting taken down with the market, then obviously you can add to those positions. But I wouldn't be making a huge move and saying, hey, this run's over, and I also wouldn't be just loading the boat, because I don't know if the correction that we've seen so far, as minor as it's been, is over. All right, folks, have a wonderful day. We'll talk to you soon.